Looking at 5 of the best REITs to buy in 2024 that analysts themselves are buying. We're going to discuss each one of these. As always, we will look at the historical performance of these companies. We'll look at their dividend safety, looking at some of their financial metrics. And as always, we will run them through our own valuation model to get to what we believe to be the intrinsic value, acceptable buy price given that investor margin of safety. And as always, we will see what Wall Street are forecasting over the next 12 months. So let's jump straight into it, and essentially these 5 companies, they have been picked by analysts, they are buying them. The reasons that they are looking for these essential REITs in 2024, well, they've had strong finishes in the last 2 months of 2023. They still have a moderate price to funds from operation ratio, so they don't look to be overvalued. And they also offer a dividend yield that is high enough to compete with fixed income assets, but at the same time, the risk isn't there of them being a yield trap. And the final and most important thing is that their payout ratio still covers the dividend without a risk of a dividend cut. So this is what the analysts are expecting for these top 5 REITs of 2024. Let's go and look and give our own analysis and assessment of each one. The first one we have is Four Corners Property Trust Inc. Now, last year we can see it was down around 11.5%. We can see currently it trades in the midpoint of the 52-week range and offers a starting yield of 5.5% with essential P to FFO forward looking of 15.5%. If you've been holding this company over the last 10 years, you can see it hasn't reclaimed that COVID pre-drop of around $32.50. So let's take a look. Dividend safety score, 46, borderline safe. We'll touch upon that shortly. Market cap, 2.28 billion, a mid-cap company. In terms of recessionary data, well, for this one, we don't have that data available. Dividend growth, well, they increased it by 1.5% last year. Not the greatest, below inflation. Remember, we always advocate a minimum of 4% on the channel to keep up in line with inflation. But over the last 5 years, 6% year on year, so above inflation, whilst getting a nice starting yield of over 5%. Now, they have only been increasing those dividends for the last 7 years. So let's take a look at dividend yield theory, and as always, dividend yield theory states that the company is undervalued when the current yield sits above the 5-year average, 5.48, 4.71, so we have our first sign of undervaluation. Bearing in mind, we're not looking at any of these models in isolation and we'll draw conclusions towards the end of the episode. Forward P to AFFO, 14.9, below 17.2, so another sign of undervaluation. And we can see it is pretty much in line with the real estate sector P to AFFO of 14.2. As always, we do typically look at the free cash flow payout as earnings are susceptible to manipulation by management through accounting. But for REITs, the free cash flow payout is a lot more volatile, so we focus on adjusted FFO, funds from operation. Below 90% is what we are targeting for REITs, and it's very reassuring to see that for Four Corners Property Trust, it has been below 90% consistently year on year. 2023's annual report is expecting to show around 82%. Adjusted funds from operation per share, very nice to see that it has been increasing over the last few years. It isn't as consistent. We do see a year or two where it does drop, but overall the trend is upwards in the right direction. 2023 and 2024 expected to be more of the same. In terms of sales growth, well, for REITs, moderate growth, we look for 5 to 10%. They had some astronomical growth in the earlier parts of the 10-year period, but from that point, it has been very good. It has been double digits quite consistently. 2023 expected 11%, and that is at the top of the lower margin we look for, so very positive. And when we look at the sales, it's gone from 17 million in 2013 to 243 expected in 2023. Very nice to note. And when we look at shares outstanding, now yes, it is diluting your position as a shareholder, but REIT investors know that this is very typical. They do this a lot. The reason for this, as they do retain a little of that internally generated cash flow after paying the majority in dividends. But do check other REITs that we will discuss not only in today's episode, but on other videos on the channel. Different REITs will dilute your position at a different rate, some faster than others. ROIC for REITs, we look for 3 to 5%, other companies 10% or more. These figures give us faith that management are able to effectively allocate their capital. 6%, very positive in my opinion for FCPT. Operating margin as well, very nice to note, that is around the 50 to 60%, so that is strong for this real estate investment trust. Now, the net debt to EBITDA, earnings before interest, tax, depreciation, amortization, shows us the balance sheet strength as well as dividend safety. 5.5 being the maximum number of years it would take the company to pay off all of their debt net of cash on hand. That's the main target. Now, 2022, it was pretty much borderline. 2023, it is expected to go higher. The positive with this is that 2024, it is expected to come down to 5.19, but it is something just to keep an eye on. So let's jump into the valuation of FCPT, and as always, if you're enjoying the content, values being provided, smash the like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. And as always, we do typically run through every single model on the channel when we do deep dives, but for today's episode of the 5 top REITs for 2024, we're jumping straight in to the intrinsic value, and it is coming to around $29. Now, that is just purely the average of those 3 models that you see on screen. Now, with the current price at $25.18, we typically start off with a margin of safety of 10%. Remember, if we believe it has a wide moat, strong financial metrics, and good forward-looking data, we can see right now we are getting a 10% margin of safety. 15% isn't quite there yet. So for FCPT, we believe there's around a 10 to 15% margin of safety based on our estimates and judgments. In terms of Wall Street, well, they see around 11% upside over the next 12 months on that share price with their target at $28. As always, as we go through the videos, let me know your comments whether or not any of these were on your radar or if you have been picking up any of these over the last few months. Moving on to the second REIT for 2024, we have HST, Host Hotels and Resorts. Now, last year they were actually up 15%. They are trading towards the mid to upper end of the 52-week range and a yield of just over 4% with a P to FFO of 10.24. Now, if you've been holding this over the last 10 years, you can see you would be in for a rocky ride, up around 6%, although do bear in mind it doesn't include those dividends reinvested. Dividend safety sitting at 50, borderline safe, market cap 14 billion. It is a large cap company. Now, we can see the last recession, they in fact cut the dividend 07-09. They had below average growth of negative 20% versus the S&P 500's negative 12, and they significantly underperformed the S&P with a negative 83% return versus the S&P's negative 55. Dividend growth, a few things to note, a very strong 11% increase just a few weeks ago. Double digits we love to see, but do note they did cut the dividend over the last 5 years, and on average over the last 10 years it has grown by 1%, and you can see that quite clearly here on the graph on screen. So they have only been increasing those dividends realistically for that 1 year. Taking a look at dividend yield theory, we can see that sign of undervaluation, and do note the missing elements due to the fact of that dividend cut. So it is looking reasonably valued based on dividend yield theory, and the forward P to FFO is currently slightly higher at 13 versus 12. In comparison, they are still sitting below the sector P to FFO of real estate at 14.2. So let's take a look at the adjusted funds from operation. Well, 2022, 22%, 2023 at 37%, 2024 expected to go higher. It is still fairly lower than the 75% maximum we do look for hotel REITs. So if they do continue to perform very well, we should hopefully see a nice, another double-digit increase to the dividend this year. Adjusted funds from operations, well, 95 cents in 2013, 153 in 2022, and you can see that COVID year, the pandemic year, well, this is a hotel REIT, and therefore it makes sense why we do see this negative here, and it has rebounded nicely from that point. Now, when we look at sales growth, we can see again negative 71% in 2020, but again rebounded very sharply, although it has come down in 2023 to 13%, which is still very positive to note. When we look at it numerically, then it has gone from around 5 billion in 2013 to 5.26 in 2023. So it hasn't grown that much or as much as we would like to see over the last 10 years. As always, though, past performance is never an indicator for the future, but it's always good to see. On a more positive note, they haven't actually diluted your position as a shareholder if you've been owning the company over the last 10 years. In fact, they have been doing share buybacks, returning excess cash to investor pockets, reducing the count from 748 million to 718. ROIC then, pretty much consistently, if you ignore the COVID years, pretty much around 7%, which is very, very high for REITs. Remember, typically we're looking for 3 to 5%, and for the very popular realty income, that does sit around 3%. Operating margin, though, we would like to see this significantly higher. We can see it at 15% in 2022 as well as 2023. But on the more positive note, it is fairly consistent over the long term. Then finally, we look at the net debt to EBITDA below 3.5 for hotel REITs. 2022, 2.63. 2023 expected to go even lower. So that is a positive note. The dividend does remain to be safe based on this information as well as that payout ratio that we saw above. So far, nothing really to warrant any issues with the dividend. Now jumping into the valuation model, and don't forget, if you click on that pinned comment below, you can grab a copy of the model to run your own companies through to get to the intrinsic value as well as acceptable buy price of companies in your own portfolio or even those on your watch list. So we start off with a margin of safety of 10%. We can see it as a buy up to $22. 15% still a buy, and at 20% we see it isn't quite there yet. So for HST, we see around 15 to 20% margin of safety. What do Wall Street forecast over the next 12 months? Well, they see around 16% upside with a price target of $23. Let me know in the comments though if any of these two that we have run through do interest you so far. We then move on to REIT number 3, and we have HR Healthcare Realty Trust Incorporated. Last year, down 17%. They are trading towards the mid to lower end of the 52-week range. They do offer the highest yield yet on the companies we've analysed of 7.1% and the P to FFO of around 11. Now, over the last 10 years, you can see you'd be pretty much flat, although it has been very rocky over this period. And when we look at that dividend safety, we see a score of 50, borderline safe. Market cap just under 7 billion, a mid-cap company. Now, in terms of the last recession, well, they didn't pay a dividend in 07-09, and they had slightly higher than average growth during that period. Dividend growth, well, they haven't increased that dividend since August 2022, and in fact, they did have a dividend cut, hence why we see a negative percentage here shown, and they haven't really increased those dividends so far. In terms of dividend yield theory, well, we have that sign of undervaluation of 7.0% versus 4.04%. Forward P to FO 15.6 versus 21.8, and when we compare it to the real estate, it is sitting slightly higher at 15.6. Importantly, the adjusted funds from operation payout, remember, below 95% for medical building REITs. 2022 was very low. 2023, a slight red flag indicator. We do see it at 105%, which means they are expecting in 2023 to have paid out more in dividends than they generated in cash flow. So something just to be wary of there. Now, when we take a look at the adjusted funds from operation per share, it has also barely moved over the last 10 years. We see some dips, it then does pick up, but overall it hasn't really moved. So it doesn't mean it's necessarily a bad company to invest in, but always understand the facts and figures before investing into any company. And whilst we do see moderate growth over the longer term, 2022 as well as 2023 is seeing some strong double-digit growth to their top line. And numerically speaking, we can see it has gone from 330 million in 2013 to expected 1.35 billion. Now, we're going to go through this again, but we can see that they have pretty much diluted your position, not at a bad rate from 2013 to 2021, but from 21 to expected 2023, they are heavily diluting the shareholders. Again, something to be wary of. ROIC, well, not the greatest, let's be honest. 3 to 5% was what we started off on this episode discussing. We can see it has come down with 2022 at 1%. So there are some red flag indicators to be wary of. And just because Wall Street are buying, analysts are discussing, it doesn't necessarily mean this is a company you should be looking at. And this is why we do our own due diligence, as you can see. So in terms of operating margin, they have also decreased that significantly from 26% to 4% in 2023. And we can see on a net debt to EBITDA basis, it is alarmingly high in 2022, although it is expected to reduce in 2023, which is positive. It is reducing from a high 10, but again, it is still slightly higher than the 6 maximum we would like to see as investors. Well, what about the valuation? Let's take a look and see whether or not this is a company that is looking undervalued on price alone. Intrinsic value at $22. Now, current price $17. If we start off with 10%, it looks to be undervalued up to $19.80. 15%, it looks to be undervalued, and it is pretty much trading at 20% margin of safety. Now, margin of safety, will depend on the investor, their thesis, whether or not they believe the industry as a whole is performing well. There are lots of different things to indicate what level of margin of safety you would like. And we can see here that Wall Street are forecasting a price target of $19 over the next 12 months with around 10% upside. REIT number 4, we have Boston Properties, ticker symbol BXP. Now, the last year down 2%. They are trading towards the mid to upper end of the 52-week range with a yield of 5.6% and a P to funds from operations forward-looking of 9.63. Over the last 10 years, well, they're down 30.2%, and we can see their all-time highs before that COVID drop of around $146. Dividend safety, 60, borderline safe. Market cap, 11 billion, a large cap company. And when we look at the key metrics for the recessionary period, while they cut the dividend, they had average growth and they out or underperformed, in fact, the S&P with the negative 68% return. Dividend growth, they haven't grown it since 2019. On average, over the last 5 years, though, it has increased by 5%, and we can see over the last 20 years a 2% increase. So they have zero dividend growth streaks. Now, in terms of dividend yield theory, we have that undervaluation sign, 5.6 versus 3.87, and the same is to be said for the forward P to AFFO ratio. Now, looking at the adjusted funds from operations, we can see they are expecting it to be around 79%, which is still considerably lower than the maximum 90% for REITs. So far, that dividend does look to be safe. Now, when we look at the adjusted funds from operation per share, it is increasing over the period. It is expecting to be around just under $5, but we can see the growth isn't as much as maybe we would like, as well as the consistency doesn't look to be fully there. Sales growth, well, they have had some decent growth over the period, but do note that 2020 COVID drop as well as 2023 is expected to be negative, and hence we see the total sales go from around 2.2 billion to 2013 to around 3 billion in 2023. On a more positive note, they don't really dilute your position massively as a shareholder, only increasing it by 4 million shares over 10 years, which isn't bad at all. ROIC, again, more positive. It is still between the 3 to 5% over the longer term. 2023 coming in at the minimum we would like to see at 3%. And the operating margin, it has been very strong for the last 10 years, although it is expected to slide slightly in 2023. Something just to keep an eye on. Hopefully it will rebound back to the historical levels. Net debt to EBITDA, so we can see why that dividend safety says borderline safe. 2022, 7.7. 2023 expect to go slightly higher. So this is one that I would keep an eye on moving forwards in terms of how they manage their debt levels. So let's jump into the valuation for BXP. Don't forget you can grab a copy of the model below, run your own companies through to essentially get your own intrinsic value as well as your acceptable buy price. Margin of safety then 10%, that's how we start off with, and we can see it is pretty much trading around that 10% level. What do Wall Street say? Well, they see around 7% upside with a price target for Boston Properties at $75. Moving on to the final REIT number 5, we have CUZ, Cousin Properties Incorporated. Now they're down 8% over the last year. They're pretty much trading in the middle point of the 52-week range with a yield of just over 5% and a P to FFO of 9.17. If you've been holding this over the last 10 years, well, you would be down around 19%, and we can see their all-time high pretty much before that COVID drop of $42. Dividend safety score, another 60, borderline safe, 3.5 billion market cap, a mid-cap company. When we look at the key metrics, well, the recession, it was cut below average growth, and they also underperformed the S&P with that negative 76% return. They also haven't increased the dividend since March 22, and over the last 5 years, a 1% increase year on year, and over the last 20 years, a negative 7%. But they have been increasing the dividends for the last 4 years. So let's take a look at dividend yield theory. Again, another sign of undervaluation, 5.33 versus 3.58, with the forward PTFO again below the 5-year average. So that's second signal of undervaluation. In terms of the adjusted funds from operations payout, pretty positive, below 90% consistently, 70% expected in 2023. Adjusted funds from operation per share, very inconsistent. On a positive note, it has increased over the last 10 years, but this isn't what you really want to see. Ideally, you want to see consistent growth year on year. Sales growth then, very inconsistent, although we do see a lot of years of very strong double-digit growth, 2017, 2013, 2019. 2022 was pretty poor. It was flat, although we see 2023 expected 5% to bring in some more or some positive news, so to speak. 2013, 211 million in 2013, 803 million expected in 2023. Shares outstanding, so they do dilute your position in batches. Some years they don't dilute your position that much. In some years they do quite significantly. But over the longer term, your position is being diluted as a shareholder. ROIC, it had some years where it was very low, but we do see it picking up. And over the more recent period, consistently around 3%. Operating margin, it has picked up from the astronomically low 2013 of 4%, and over the more recent period in the mid-20s is a positive sign, especially as it is consistent. Net debt to EBITDA, well, it's positive to note it's below 5.5, still fairly high, but 2023's 4.9 is positive. It has been coming down from the previous year, but something you may want to consider. So let's get into the valuation of this final great REIT for 2024. And don't forget, if you enjoy the content, values being provided, smash the like button, hit that subscribe and bell button so you can be continually notified of these videos as they drop. So a 10% margin of safety, we get an acceptable buy, not too far off the current trading price. So for Cousins Properties, we see around 10% margin of safety. What do Wall Street say? Well, this is the one they believe to have the most upside at around 21%, with a price target just shy of $30. As always, do let me know your thoughts in the comments below. These are sort of the under-radar REITs. We have typically talked a lot about realty income, VICI properties, and a lot of those popular ones. But these are ones that we can see from that article that analysts are looking to buy. But as always, let me know your thoughts in the comments. If you've enjoyed today's episode, smash that like button, hit the subscribe and bell button. And as always, have a great day and see you on the next one.